Let's talk about the housing market. Now, of course, this isn't my area of expertise, but I did want to talk about kind of my thoughts on housing in 2022, where I see the current market and what may happen. Also, I have some interest in following the market just because I am thinking about getting into real estate over the next couple of years. Now, a big piece of real estate is the interest rates people can get on loans in order to buy real estate. And the big thing in 2022 is that the mortgage rates has exploded to the upside. Here's a chart showing the 30-year mortgage rate from 2020 all the way till now. You see 2020 dip below 3%, 2021 range around under 3% as well, and the beginning of 2022, you got this huge increase. Let's take a step back and ask, why are rates higher? And a part of that is our favorite party to blame for everything, the Fed, and when they're increasing the federal funds rate, also kind of shadowing to the entire market, they're going to continue to raise rates in order to deal with inflation. That tends to increase the yields or rates that we see on loans, bonds, pretty much anything in the lending market goes up. So you would think with higher rates, maybe the market sells off in terms of pricing, but that doesn't necessarily happen right away or doesn't necessarily have to happen. If you ask anyone that's older or has been around the real estate market, they'll tell you that 5% is still historically pretty low for rates. And going back to the 80s, rates got above 18%. That sub 3% levels were ridiculously low. And the reason that we're seeing the real estate market so hot was partly because of those lower rates. Here's a simple example. You have a house in Chicago, $475,000. It's a 2-unit flat. You look at a 5.25% interest rate, 30 years, 20% down. Your estimated monthly cost is going to be around $3,100. But if we had locked in a 2.75% rate, you can see that the monthly cost all of a sudden goes down to $2,600. So around $400, $500 cheaper per month for anyone that's buying the same property a few months earlier. Outside of the rates that have an influence on the price of housing, you also have the supply of housing. If there's no houses on the market and the demand is slightly increasing, that's going to put pressure on the price of housing. And looking at this chart of monthly supply of houses, every time we've kind of run into a real estate bubble, if we look at 2008, 2009, there was a massive amount of supply of houses on the market. Looking at 2020, we dropped down to around 3 million monthly supply of houses in the US. And that was a historically low point in terms of supply. So when everyone was staying home, the demand for houses were higher, the interest rates were lower. That was recipe for the price of real estate to increase. Here's a chart of the median sales of houses, and you see at the beginning of 2020, that's when housing prices really started to skyrocket and currently are still relatively high. And with the stock market and cryptocurrency having a correction since the beginning of the year, everyone is looking to real estate and asking the same question. But before we get into that, I did want to talk about the sponsor of today's video, iTrustCapital, which is a crypto IRA, which allows you to invest in crypto with tax advantage accounts. One of the benefits of using an account that's associated with retirement is not touching the money that's invested. Having that long-term stance may help you. Also, if you do think that Bitcoin is actually going lower and you're looking to actually buy the dip, what's kind of cool with iTrustCapital is they've introduced conditional transactions, meaning a limit order. So if you don't want to buy Bitcoin unless it hits 20,000, you can set up an order to buy Bitcoin at that price and just forget it. If you're looking for a crypto IRA, check out iTrustCapital, and you'll also get $100 if you use the link in the description below. Now back to the video and why real estate is a little different than stocks and crypto. Because real estate isn't as liquid as something like the stock market or crypto, also you have people that are living in houses. So people aren't necessarily going to just sell their house because the price is high. Well, they're going to have to move somewhere, and the price of a house that they're buying is also high. And then you have people that locked in lower rates, so 3%. Why would they sell and buy a house with a 6% rate? It just doesn't make sense. So people are not leaving their houses because they already have low interest rates. There's a supply shortage. The cost of producing a house or building a house from scratch is still more expensive than the price of a median used house. All of this together, I think there's a little bit of room for the sales to kind of cool down, but I don't think we're going to crash. What could happen if there's a recession? Well, if people are buying houses that they can't really afford, they lose their jobs, all of a sudden they can't really pay that that mortgage, they end up lowering the price, selling it, take a loss. Well, you have kind of a ripple effect that can once again lead to more houses coming on the market, people panicking that the prices are going to keep on dropping. You have a feedback loop, and once again, there's deleveraging. People that are over leveraged kind of get wiped out. And what I've found is the best indicator for a market being too hot is the number of TikTok gurus that you see talking about a specific market. And right now, you're seeing a lot of real estate TikTok gurus really boasting about their strategies. And here's an example.
This is how we went from 0 assets to $5 million in assets in our first 2 years in real estate.
When we first
Yeah, it's called leverage.
started, we didn't know anything about private lending. So we were actually using our own money, buying one property, refinancing, getting that money back, buying another property, which was really slow.
Yeah, it's slow, but it's safer.
We got to the point where we maxed out how many loans we could have in our personal name, so we had to look for other alternatives.
That's when we figured out the private lending game, and we took off like a damn rocket.
But the problem is they are heavily in debt as well. So at the beginning, they were saying 5 million in assets, but they don't mention how much of that is in liabilities. How much of that real estate is actually equity versus loans on that real estate. And that's the dangerous part about using leverage. It can help when times are good, and if you can avoid a huge recession, then all things can work out for these people. Whereas if there is a downturn, then that's when leverage bites you in the ass. So if a recession happened and it's very tiny, right? You have a technical recession, GDP is lower for 2 quarters in a row, but the landing from the Fed is soft, isn't too bad, and not a ton of people lose their jobs, right? Unemployment right now is pretty low. I don't think the housing market is really going to take a crash. Now, if you go into a hard recession, then yes, I think housing is more vulnerable. And of course, when I'm talking about housing, I'm talking about as an average. There's probably always going to be markets within the US that are always hot. There's probably going to be markets that get really destroyed if we have a recession. It's very geo-specific, but when I'm looking at the overall numbers, there is one other metric that is a little alarming to me when you look at the median sales price for a house versus the median household income for the US. If you look at the median household income back in 2005, it was around $61,000, and the median price of a house, let's say $240,000. That means back then the price of a house was around 4 times the median income for a household. Whereas if you compare the ratio now at 6.4, that means the pricing of houses has drastically outperformed the increase in wages. Right now is one of the highest periods in terms of pricing for houses versus your median salary for household. So yeah, when I see a metric like that and all these memes about not being able to afford a house because it's so expensive, especially in these hot markets. You're talking about San Francisco, any of these bigger cities. Some of the pricing is just insane, and unless you're working for the top companies having an insane salary, or if you're a surgeon, you have to be basically rolling in it in order to afford housing in some of these markets. At some point, that doesn't work. When people are over leveraging, buying houses that aren't affordable, there's always going to be an equilibrium. And I think we're kind of headed towards that. I just don't know if there's really a crash. You could have some absorption. In my plan is always to kind of ignore these cycles and kind of focus more on, can you afford a house? Whether it's an investment property or your own, can you actually realistically afford it? If $500,000 is outside your budget with current interest rates, well, you need to look for a cheaper house, move somewhere else, or just rent and hope that the equilibrium comes down. That's just my opinion. I think just jumping in because you have FOMO about runaway pricing can lead to some pretty bad decisions. So how do you know if you can afford a house? To figure out affordability, you can use the 30-33 rule, which essentially says 30% or less of your gross income should be going to the monthly mortgage payment. You should have at least 30% saved up in order to actually buy the home, which I think is a little ridiculous. Personally, I don't think even having to save up for 20% is necessary if your job is pretty stable. If you're a little bit more risky, taking advantage of an FHA loan, 3.5% down, it really comes down to kind of what your risk tolerance is. But 30% saved in cash, I think is a little bit overkill. Usually it's 20% in order to avoid PMI. And then the last rule is 3. So 3 times your gross income is what house you can afford. So if you make 100 grand, your household can buy is around 300,000. Selfishly, I'm hoping for a bit of a correction, but I do not wish for a hard recession where you have a collapse in housing, because that will take down the economy way worse. I don't think anyone wants to relive that in terms of the 2008-2009 crash. That's no bueno. But if we do have a bit of a correction and have housing fall back into an equilibrium for the median pricing versus the median income around 5, I think obviously then it's a little bit more of a healthy market. There's not as much speculation, and buying a house at that point is just more attractive. But I'll say I am saving in a high yield savings account, as well as I'm considering buying I-bonds, because I'm kind of looking out past a year before I would be buying something. Of course, I could liquidate some assets and probably buy real estate right now. But like I said, I'm kind of building up a little bit of a cash position, or a bigger cash position, and looking for a little bit of a pullback, I think, which will come in about 2 years. Year to 2 years could be the sweet spot. But yeah, I figured I would talk about housing, kind of throw out my opinions on what I think is going on. Again, I'm not the real estate guru, not my expertise, but hey, I thought it'd be fun to share. If you guys did enjoy the video, make sure to hit that like button and consider subscribing to Main Street Wolf, where we talk investing, anything to do with money. Thanks guys for watching, and have a great day.